Ladies and gentlemen, welcome to this new video. We are well aware that the majority of market exchanges are controlled by a handful of large banks, and in recent years, numerous concerns have been raised about the unethical actions carried out by some of the major financial institutions. In fact, hefty fines have been imposed on these operators. Therefore, denying the occurrence of these market manipulations is sheer folly, and anyone who claims that the market cannot be controlled is simply delusional. Today, we will discuss a very interesting and controversial topic: the manipulations of the Asian session in the world of trading. During the Asian session, between 11 p.m. and 8 a.m. in the morning, volatility and volumes tend to be lower compared to the London and New York sessions. During this time window, market prices tend to move sideways or consolidate. Between 8 a.m. and 10 a.m. in the Italian time zone, a particular situation arises, which we call the London manipulation. Within this time interval, the algorithms used by major market operators strategically act to trap other participants, exploiting the highs or lows of the Asian session as bait. These algorithms are programmed to push the price beyond these key points, attempting to generate a false movement. These fake breakouts may occur several times before the real movement takes place. The reason is simple: the big players cannot enter the market whenever and however they want. They need liquidity, and there is a significant amount of liquidity above these price levels due to stop-loss orders and pending orders. The major operators will manipulate the price precisely to take as much liquidity as possible because they need a counterparty to execute their trades. We must not blindly engage in this manipulative game. Instead, we should leverage this phenomenon as a statistical advantage, a weapon for our success. During the Asian session characterized by sideways movements and low volatility, we patiently await our time window from 8 a.m. to 10 a.m. This is the period when the statistical advantage is greater. However, this does not exclude the possibility of attempting trades at other times, such as the opening of the New York session or the closure of the London session. We wait for an imbalance in the high or low during this time window. Now we have two options to enter the market. The first method, which represents a more aggressive approach, involves entering the market when the price returns within the Asian range, at the moment when a break-in of the level occurs. This allows us to promptly exploit the temporary imbalance. However, we must pay attention and assess whether there are significant buy or sell orders above or below the price level that could be manipulated. The second method is more conservative and, in my opinion, more profitable: waiting for a change in structure on the chart within our execution time frame. Personally, I prefer using the second method because more often than not, the price makes fake breakouts before moving in the direction we have defined. The choice between working with the low or high imbalance will depend on our analysis and the strategy we have defined for that specific day. It is not a random decision but a calculated and careful one. We must consider factors such as the direction of the trend, key resistances or supports, and liquidity zones. We should not be swayed by emotions or act impulsively, but rather act based on market conditions and our well-defined strategy in advance. Remember to carefully study your chart, evaluate market conditions, and always practice proper risk management. If you have any questions or comments, please leave them below, and I will be happy to respond. See you in the next video.